I'm Matt Bishar with REIT.com here in San Diego for REIT World 2012. Joining me for this edition of CEO Spotlight is David Henry, the Vice Chairman, President, and CEO of Kimco Realty Corporation. Welcome, David.
Thank you. It's always a pleasure.
Now, Kimco's back-to-basic strategy seems to really have resonated with shareholders and analysts, and the sale of the in-town suites was another step in that plan. Why do you think it was so important to concentrate on your core retail portfolio again in this environment?
Well, Kimco is a 50-year-old company that has specialized in retail real estate for almost all of its 50 years. It started in the 50s developing shopping centers in Florida, and then depending on the cycle, either acquired or developed. And so its core expertise, its relationships that it's built over these decades are generally retail oriented. So from time to time, Kimco has invested in other asset classes, made some money in those asset classes, but clearly, post the Great Recession, our investors and our shareholders want us to concentrate on our core expertise, which is neighborhood and community shopping centers.
Now, given the work that you've done to focus on that, how would you describe where your balance sheet is now? Is it where you want it to be? Is there more work to do?
Sure. You measure balance sheets in a number of different ways. Most of us have migrated to a net debt to EBITDA type of level. 3 years ago, we were in the 8-ish range. Today, we're 6 and maybe a little under that. We'd like to get our fixed charge coverage up just a little bit, but we are very proud of the fact that we're one of only 11 REITs that are rated BBB plus or better. So we're at the higher end of the credit range as it is, but perhaps a shade more EBITDA in terms of coverage is where we'd like to be. So look for Kimco gradually to be 5.5 to 6 net debt to EBITDA over time. We think that's a proper range for the balance sheet, and it probably equates to 40-45% loan to value, if you will.
And how confident are you in consumer sentiment and consumer shopping habits kind of getting back even more than what we've seen in the recovery so far?
Well, it is interesting that consumer confidence hit a 4-year high recently, especially with this giant asterisk out there called the fiscal cliff. So I think we're all apprehensive about next year in terms of the government coming up with this grand compromise. The sooner they get on with fixing this and meeting in the middle, if you will, this fiscal situation. I do think there's a momentum to the recovery in terms of consumer spending and the shopping center industry, and we hope it maintains that momentum. And so we're cautiously optimistic about the holiday season. The back-to-school season was good. Most of the national retailers are reporting pretty good same-store sales growth. So we're, again, cautiously optimistic about this season.
We know the economic challenges facing the retail sector in the U.S., but how are your portfolio in Mexico and Canada faring, and what's the outlook there?
The Canadian economy continues to be strong. The banking system is strong. Housing is strong. They have the natural resources. They don't have some of the fiscal debt problems that the U.S. has. The currency is strong. A couple minor clouds in terms of fashion sales, probably due to their high currency right now. But in general, the long-term prognosis for Canada is excellent. We're very happy with the assets that we have in Canada. Our only challenge is really how do we grow in Canada because prices are so high. Mexico, the recovery has taken hold there, and the case for Mexico continues to be it's very under-retailed compared to the United States. The U.S. has about 100,000 community and neighborhood shopping centers. Mexico only has 1,000 shopping centers for 106 million people. So there's great demand. Mexico recently reduced the tariffs on Chinese goods, which has allowed some new retailers to expand into Mexico. Gap being the most recent, Bed Bath & Beyond being another one that's expanded into Mexico. And you still have people like Walmart and Home Depot that are growing very aggressively in Mexico. So again, long term, we think Mexico also will perform very well for us.
David, thank you so much for joining us. For more on this and other REIT news and analysis, be sure to visit REIT.com.